Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Nordic American Tankers stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Nordic American Tankers is an oil tanker shipping company with 24 suezmax ships. The reason the ship is called suezmax is because it's capable of passing through the Suez Canal. Not all ships are able to do that. NAT sold its NORDIC SIRIUS ship last month for $14 million. Also last month, it bought two Newbuildings for $55 million per ship. After those two transactions, it currently has 24 Suezmaxes. The average age of its fleet is 12.2 years, and each ship can carry about 1 million barrels of oil. 46% of the active Suezmax ships in the market are over 15 years old. These ships can last up to 30 years, but it may not be economically viable to keep it past 20 years. The supply of ships in the market is highly correlated to the profitability of these shipping companies. The cost to maintain the ships is fairly fixed, depending on the age of the ship. The revenue each ship receives can vary a lot depending on the number of ships in the market. There will always be demand by companies looking to transport oil across the ocean. To transport oil within the US or any country, it is usually done through pipeline. Transporting oil between Canada and the US or between any two connected countries is also done through pipeline. Transporting oil from Africa to the US by plane is too expensive, since you cannot fit that much oil on a plane. Shipping oil by vessels is the only viable option. When the number of ships in the market falls, then the remaining ships are able to charge more per delivery. When a shipping company makes a lot of money, they usually buy more ships to keep growing. When the number of ships in the market gets too high again, the shipping companies are unable to demand higher prices anymore. This vicious cycle seems to happen quite often in the oil shipping industry. Another thing to consider is the price of steel and other commodities. When steel prices are high, shipping companies are more likely to scrap old ships. When steel prices are low, shipping companies are more likely to buy new ships. There are 548 Suez vessels around the world, which is a lot lower when you compare that to prior years. There are 30 Suezmax tankers that should be delivered next year, 8 in 2023, and only 1 so far in 2024. Shipyard capacity has been booked by bulk, gas, and container ships. This means there is less capacity for new tankers to be built, which means less supply and higher rates for the shipping companies, which results in a higher stock price for you. This is a great sign for NAT and its investors. The company is headquartered in Bermuda and was founded in 1995. It trades on the New York Stock Exchange, London Stock Exchange, and Deutsche Börse. Let's get started with the model. This is a small cap company, 340 million market cap. They're trading at $2 a share, and they have 172 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. So they did have positive free cash flow in 2 years, negative in 2 years. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's only positive in 2020. Revenue is a sales for the company, and that peaked in 2020, and it dropped a lot in the trailing 12 months. This is their income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was negative in trailing 12 months due to really low revenue. Below that is their operating expenses, and below that is their operating income, which was negative in 2018 and the trailing 12 months. They have 340 million of debt on their balance sheet, so they paid 26 million of interest on their debt, which was a lot lower than 2018, 19, or 20. And the bottom line of the income statement is their net income, which was negative every year except in 2020. This is the company's income statement from their quarterly report. This is the first 9 months of 2021, and their revenue was only 45 million. For the first 9 months of 2020, it was 217 million. So 2021 has been much worse than 2020. It's a combination of less demand and lower rates. And it cost the company $51 million just to operate the ships, $11 million in general and administrative expenses, $52 million in depreciation, and $8 million of impairments. So their operating income is negative $78 million. They pay $20 million of interest on their debt, so they had a net loss of $100 million. It looks pretty dismal. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. So they did well in 2019 and 2020, but they got crushed in the trailing 12 months, losing $52 million of cash flow. They spend money each year on CapEx because when they buy a vessel, that goes into CapEx. And the cost of that vessel is carried on their balance sheet and depreciated over its useful life. Operating cash flow minus CapEx gives you your free cash flow. And that was a big negative in the trailing 12 months, positive in 19 and 20, negative in 2018. They've been paying down more debt each year than they've been issuing. The way they fund their growth and fund their dividend is with stock. They issued $18 million of stock in 2019, $21 million, then $58 million. When a company issues common stock, it increases the shares outstanding, making your shares less valuable. It gives you a smaller piece of the pie. And they've always paid a dividend, even though they can't afford it. They did cut their dividend to 1 penny though. This is the company's statement of cash flows for the first 9 months of 2021. They don't give the detail for cash flow from operations. They just give the number. They lost $38 million from their operational business. They do give the detail in their investing and financing section. In their investing section, they spent the entire $15.4 million in acquiring new vessels or fixing up their old vessels. In their financing section, they issued $55 million of common stock, so that's a cash inflow. They financed one or more of their vessels, so they paid $6 million on that. They borrowed money in the past on a credit facility. They paid $12.6 million in the first 9 months of 2021, so that's a cash outflow. They paid $1.1 million in fees related to their financing facilities, and they paid out $6.2 million of dividends to their shareholders. So they had a cash inflow of $29 million from their financing section. Let's look at the capital structure. They have $548 million of equity, $340 million of debt. They're 62% equity, 38% debt. I gave them the middle whack on Finbox, 12.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year, for that $722 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $388 million. We divide that by 172 million shares. And we get a calculated stock price of $225. They're trading at $198, so they're trading at a 12% discount. It's a buy according to the model. The average analyst projects their revenue to grow 53%. I thought 53% was a bit high, so I grew it 20% a year for the next 4 years. That's how I got their future revenue estimates. I figured they would have negative free cash flow through 2023. The way I calculated their 2024 future free cash flow, I need to see what percent of their revenue they convert to free cash flow. So I took the sum of these two free cash flow numbers, which is 143, and I divided by the sum of these two revenue numbers. And that comes out to 21%. So it looks like they convert 21% of their revenue to free cash flow. So I multiplied this $331 million by 21%. That's how I got the $70 million. The stock price has come down so much, so unless you think the company is going to go bankrupt, there seems to be a lot of upside. Simply Wall Street's valuation is 147. They're saying it's 34% overvalued. 4 analysts priced this stock and the average price target was $3. The low was $225, the high is $4. In the third quarter, the company only received $5,800 per day for their ships. In the second quarter, that was $7,800 per day. The average for the past 30 years is $30,000 per day. So you can see how low rates are these days. The company said it secured contracts for $20,000 or more per day for 4 of its vessels, which was a lot higher than the spot rate in the market. These lines show OPEC's oil demand forecast in 2019, 2020, and 2021. In all 3 forecasts, oil demand should grow until 2035 and then stabilize. Even with the push for renewable energies, oil demand will still be high for the next 10 to 20 years. This is where the stock has been trading the last 2 years. So I don't see much of a correlation between oil prices and their stock price, which I was a little surprised with. I thought the higher the oil price is, the more demand for this company. But it seems like when oil prices got to the lowest point, when oil was negative, their stock price shot up to $9. And you could see all the buying activity on this day, a ton of activity. The reason oil prices went negative is because there was nowhere to store the oil. And these tanker companies had these huge vessels that can store 1 million barrels of oil on each vessel. So that's why their stock price went up so much. It came down just as quick as it went up. And now the stock is trading at its lowest point ever. So like I said earlier, unless you think they're going to go bankrupt, it seems like a good price point. They always pay a dividend, but they cut it to 1 cent. That's still a 2% dividend yield. I don't think they should be paying a dividend until they could start generating positive free cash flow consistently. And they have a low beta, 0.44, so the stock moves about half the market. It's gone down 42% in the past 52 weeks, while the S&P is up 25%. The 52-week low was 177, the high is $4, and the stock is trading below its 50-day and 200-day moving average. 3 million shares are traded each day on this stock. Of the 172 million shares outstanding, 167 million are on float, 31% are held by institutions, and 2.5% of the shares are shorted. They don't have many employees, only 20, and it's been pretty steady for the past few years. This is a really cyclical industry. You really have to time it right. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd be at $3,000 today. That's a 70% loss. But you can see how much the stock moves. It was up, then down a little bit, then up a lot, then down a lot, and it could be back up a lot in the future. 70% of the shares are held by the public, 28% by institutions, and 3% by insiders. The biggest shareholder is BlackRock at 5.4%. They own 9.3 million shares valued at $18 million. Then Allspring at 3%, Morgan Stanley at 3%. The CEO of the company owns 2.8%. His value of the company is $9.5 million. And then State Street, 1.5%. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is pretty good at 1.9. That's stock price over sales per share. So investors are paying $1.90 for $1 revenue. And all these shipping companies have really good price to book ratios. This indicates the company is worth more in bankruptcy than an active business. If they sold all their ships, paid off all their debt, they would be able to give each shareholder $3.19, even though each share is trading at $2. They have a good current ratio of 1.4 and a good quick ratio of 1.2. They have $32 million of cash on their latest balance sheet, $8 million of receivables, and $17 million of inventory. It looks like they plan on selling some ships with a book value of $30 million. So they do seem undercapitalized. They had negative $80 million of free cash flow in the trailing 12 months. They have $30 million of working capital, and they pay out $7 million of dividend payments, so they're short $57 million. So they're going to need some debt or equity financing to get through the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 3 other companies in the same industry as NAT. And if NAT has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. We can't look at their PE since they have negative earnings. Same thing with Tops, they also have negative earnings. Their price to sales is a little worse than average. They have the best price to book of all the companies. They have a good current ratio. They have the worst ROE. They are lower than average in debt. And they're the biggest company on this list. All the companies combined are less than 1 billion market cap, so it's a really small industry. And they're the only company that pays a dividend. So to summarize, I have them trading at a 12% discount. This has always been a really difficult industry to turn a profit. And if you invest in this company or similar companies, you may be down a lot. And that's just the nature of the industry. You really have to time it right. And if you catch it on a downtrend, you may never come back. Because companies like this tend to do reverse stock splits pretty often, which can dilute your investment. So is this the bottom? No one really knows for sure. But if you can time it right, you can make a ton of money. I rank their free cash flow as 1 out of 10, their revenue 2 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.